Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're diving into Oscar Health's third quarter 2025 results, and boy, was this one a head-scratcher. We're going to unpack a story of fantastic internal execution running headfirst into some pretty serious industry-wide headwinds. The whole quarter for Oscar Health can really be summed up in just three moves. A beat on the bottom line, a miss on the top line, and a stock that faded hard after an initial pop. So the big question is, what on earth drove that dramatic turnaround? So right off the bat, you can see the conflict. On one hand, Oscar delivered a solid earnings beat. Their loss per share was smaller than Wall Street expected, which is great. But they missed on revenue. And that set up a classic tug of war between the bulls cheering for cost control and the bears who are getting really worried about growth. Okay, let's get into it. We need to break down the underlying performance to really understand what's going on here, because as you know, the devil is always in the details. This quarter was a perfect story of a company's internal discipline clashing with some pretty tough external pressures. On one side, Oscar showed fantastic control over its operating expenses. Really impressive stuff. But on the other side, rising medical costs across the entire industry created this massive headwind that, frankly, they just couldn't outrun. Now, this is where it gets really interesting. Look at that contrast. The SG&A ratio, that's their operating cost metric, improved a ton, which shows management is absolutely executing on what they can control. Plus, membership growth was super strong, up 28%. But then you see the big ugly number, that medical loss ratio, or MLR, which spiked way up to 88.5%. This was all about what they call market morbidity. Basically, people were sicker and needed more care, and that hit the whole industry. All of this led to an adjusted EBITDA loss of about $101 million. So you're probably thinking, with such a mixed bag, why did the stock jump in the pre-market? Well, it wasn't about the quarter they just reported. Nope. It was all about the confidence story management was telling about the future. In this right here, this quote from the CEO, this was the line that got investors excited early on. It painted this crystal clear picture of future profits and basically told the market, hey, don't worry about the short-term noise, our long-term plan is solid. And to put their money where their mouth was, management held firm on their full-year guidance. They didn't flinch. And that was a huge signal to investors that, despite the choppy waters this quarter, they believe the ship is still heading in the right direction. Okay, so if the story for the future was so strong, what in the world happened? How did the market go from being so bullish to so bearish all in a single day? This timeline just shows you the whiplash in real time. That initial pre-market pop was all about the headlines, the earnings beat, the steady guidance. But as soon as that opening bell rang and the serious traders started digging into the fine print, that whole narrative just completely flipped on its head. So what was it? What were those details that so completely reversed the initial good vibes? What did the market dig up that it just did not like? It really boiled down to three big worries. First, that nasty medical cost ratio, and specifically a big increase in something called the risk adjustment payable. Think of it as a flag for higher future costs. Second, the potential for share dilution. The company swapped some debt for about 23 million new shares. And third, that top-line revenue miss just kept nagging at people, sparking real concerns about slowing growth. In the end, these worries just completely overshadowed the good news on the bottom line. And the trading volume tells you everything you need to know. Over 30 million shares traded hands. That tells you this wasn't just small-time investors taking a quick profit. No way. This was the big money, the institutions, making a major shift in their positions after they got a look under the hood. All right, so with all that context, here's our take on Oscar Health as we look toward the next quarter and beyond. Going forward, all eyes are going to be on that medical loss ratio. Management's big move to counter rising costs is a pretty aggressive 28% average rate hike for their 2026 plans. Whether that works is going to be the key story to watch. We also expect a pretty typical seasonal dip in membership next quarter, but their fantastic cost control, yeah, that should definitely continue. So, here's our verdict. We're calling this a market perform. Look, the path to profitability in 2026 is absolutely credible. Management is doing a great job with everything they can actually control. But, and this is a big but, the risk from those broader medical cost trends is real, and it pretty much balances out all the internal positives. We think that's going to keep the stock trading in a range for a while. So, ultimately, it all comes down to this single question. This is the whole thesis in a nutshell. Can Oscar's excellent internal execution win the race against this external monster of rising healthcare costs? The answer to that question is probably going to tell you exactly where this stock is headed next.
And remember, this is for informational purposes only. It is not financial advice.